So let's dig into this 10-year anniversary and look at the markets over the last 10 years. And what we really want to draw out from this conversation is the emotion that we felt 10 years ago from that March date where the market set its low. Well, let's start with returns. What's happened over the last 10 years since we made that bottom? And as we'll see by the chart here, returns annualized have been somewhat extraordinary, where small caps led the charge, earning over 15% per year annualized. Now, what's important when you look at these very healthy returns of the Russell and other equities is that we were coming off an extraordinary low. The S&P 500 in the 600s, now 28. The Dow Jones Industrial Average around 6,000 and change, now again in the mid-20s. This move was somewhat exceptional. But I think it's important to note, we shouldn't have been at the sixes to begin with. That last phase of that big bear market was dramatic, down and up in a reasonably short period of time. What hasn't worked? Well, commodities have performed poorly. Bonds and hedging instruments have performed poorly, and that makes sense. When we have a raging bull market for 10 years, anything that hedges that bull market is going to underperform. So as we look back a decade ago today, we thought we would show you some of the headlines just to put us back in that place. This is so important as we start to make decisions in the future, and you as an investor are trying to make decisions in what has become a heated market in certain areas. We want to draw from that experience so that we use it to make great decisions. Take a look at these headlines. The Great Recession, as it was called. The American dream is over. Time rethinking home ownership. What did we hear? We heard millennials won't buy homes. We heard millennials aren't going to put money in stocks. The stock market is dead. The world's on edge. Look at the what's next with the swirling toward pull going into oblivion, the crash, meltdown. This is what we saw and heard every day. It's no wonder the stock market made such a dramatic low, because what we were being told day in and day out is not only is it a disaster, but it's just the beginning. And this is an important point. As we look at the next chart, the S&P 500, which was down almost 60%. To be clear, a bear market is minus 20. The average bear is minus 30. Average. This one down 57%. Extraordinary by any measure. And so think about what causes a market to get to that place. Desperation. Absolute desperation and fear. People giving up on those core values and principles that they know are the smart way to invest. Stay in the game. Don't panic. Don't make short-term decisions. When you finally reach that point of desperation, this is what happens, a dramatic downturn. We're pushing this point and showing you these numbers and these headlines because we want you to go back and feel that emotion, because that emotion will guide you the next time this happens. And in fact, as we look at the next chart, suddenly that gigantic dip doesn't look as dramatic. This dip, as you can see by the red line, that's the bottom of the market. And look at what's happened to the market over the next 10 years. Fantastic prosperity in the stock market. So with the benefit of hindsight, we get to look back and say, well, of course that was a great time to buy. Of course we should have invested money. And boy, if I ever get that bear market again, I'm going to know what to do. But what we also know, Warren Buffett says, what we learn from history is that we don't learn from history. And so what we're trying to do with this part of the analysis is to put that history back in front of you so that we can learn from it. And the key to this is remember, greed, fear, forget. You want to be greedy when everyone's fearful. You want to be fearful when everybody's greedy. And most importantly, remember when everybody forgets. Let's look at some of the economic data, by the way, because our economy has recovered dramatically. Here's the jobs numbers, and you look back during the 06-07 period when the economy was doing great, kind of like it is today. Unemployment numbers low in the fours, and look at that run up for the unemployment numbers up into the double digits. Extraordinary problem. Look at this Time magazine. The new hard times. This is the Depression. This picture on this Time magazine is the Depression. They had us going into a decade-long depression, but as we know on the next page, that's not what happened. And in fact, we now have less unemployment than we did back in the high times of 06 and 07, the strongest job market that our country has ever seen. And so as we look at this dramatic and steady decline in unemployment claims, again, it speaks to a somewhat dramatic recovery. Home ownership. I mean, this is what touched it off. If anybody talks about, wow, what was the big cause of that dramatic bear market 10 years ago, it was homes. The rampant speculation, the run up in these extraordinary prices, people owning 5, 6, 7 homes, trying to flip homes, and debt vehicles and 120% mortgages, all of that built up this froth to create the bear market. So as we could see, and we look at the foreclosure numbers back in 08, 09, 010, the numbers were very, very high, much higher than normal. And we heard that it'll never come back, that this is permanent, this change is permanent. Again, all bear markets, and for that matter, all bull markets, what do we hear? This time it's different. This time it's permanent. Well, no bull market case is permanent, no bear market case is permanent, and you can see that here as home ownership recovered, foreclosures went down, and we have, again, a much, much stronger economy. Here's a couple comparison numbers over a decade. GDP obviously declining in the Great Recession now, most recently up 3%. That's fantastic growth. Manufacturing numbers are strong. I won't go through all these, but let's look at a couple of them. Unemployment rate from 8.7 10 years ago to 3.8. Remember, that unemployment rate kept going up beyond the base of the recession. Our Fed funds rate, which was essentially zero, the Fed has been raising rates. It's up to 2.5. That's healthy. We need that. As we look down, the Fed's balance sheet growing. They put a lot of capital into the system, obviously, to stimulate the economy. Look at the high yield spreads. So the Treasury has barely moved from 2.6 to 2.6, but high yield spreads, which is the difference between the yield on a high yield and a Treasury, went from 15% to 3%. When it's 15, that says the whole world is in a panic, and we think the world economy is going to collapse. And at 3, that says the economy is strong. And then we see earnings in the S&P 500. We already looked at the price. Earnings up significantly, and across the board, we see dramatic changes in the market. I'll point the last number, the VIX, 44. That's volatility. Anything over 20, you're approaching a bear market. 44 is extraordinarily high. We are now below average at 12. So this is the 10-year history, and I hope what this causes you to do when you go back through this is remember the feeling as we go into the 10th year of this expansion and we continue to see the stock market go up. What we're not advocating is jumping out when things are low or going all in when things are high. It's a steady, stable, consistent process throughout markets. So with that said, let's dig in to the first quarter of 2019.